Hi everyone. The Warren Buffett Way is a very famous book written by Robert Hackstrom. And this book talks a lot about their strategies, especially Warren Buffett's strategy, what he followed in Berkshire Hathaway. And it's a very interesting book, must-read book. But I thought I found from this book, somebody had put up a concise view of this book summary and his strategy, Warren Buffett's strategy is in just one page. And I thought that is all there is in terms of to learn about investing. If you go through this one page and understand what Warren Buffett did right. So I thought I'll present this in in one of my YouTube videos, because this is not prepared by me. This is straight out of the book. Somebody has created a summary out of it, and I mean, I would rather recommend reading the book. But if you find this particular slide interesting, you can take a printout and keep it in your desk or somewhere, read every day, because this particular slide summarizes everything about investing, right? So on your screen is what you see Warren Buffett explained. The main idea is he is one of, obviously we all know he's one of the most successful investor over the past 30-40 years, and his entire approach is to focus on the value of the business and its market price. Now what the Buffett approach to investment is, there are 4 points here which you need to take into account. The first one is never follow the day-to-day fluctuations of the stock market. Most important thing. The market only exists to make it easier to buy and sell, not to set values. The whole purpose of stock market or capital markets is to feed the capital to the companies who require capital, and in return the shareholders benefit from providing the capital and holding the companies through its growth stage, right? So it is as simple as that. So market should be considered as a means of transacting to buy and sell stocks of companies. That's pretty much serves the purpose by the market, and it should not be considered to track day-to-day fluctuations or price variations. Keep an eye on the market only for someone who is willing to sell a stock at a not to be mispriced price, right? So that's the only reason. You can also look at it. I would add one more point to that, is you can track the markets also to see when the bargains appear, when sometimes many often market throws good bargains of companies that you like. So that should be another reason why you should track markets, but not to do actions day in day out, like trade in trade out, right? That's not the reason. Second point, don't try and analyze or worry about the general economy. Another most important thing. So all these are against the common trend out there, what you see being an investor or a trader, that people often tracks day-to-day fluctuations of the markets. That's the first point. Buffett says don't do that based on his principle. Second point is, don't try and analyze economy and macro picture too much into it. Don't worry about it. But people most often we all track day-to-day news channels where the only discussion is about macro and economy, which is to be completely avoided. I think Peter Lynch said if you talk about the macro for 14 hours or something, you wasted for some amount of time, 3/4 of the time. So it's like it's a waste of time just discussing and predicting the future based on the macros. Third, buy a business, not its stock. So we should always look at, this is one of the fundamental things Buffett learned from Benjamin Graham's book Intelligent Investor. When we buy a stock, we should look at the business behind it. It's not the ticker that should carry value. It's the fundamentals that should carry value. For a ticker, what it shows is just the price. Price is what we pay, value is what we get, as Buffett said. So that's the fundamental thesis. Treat a stock purchase as if you're buying the entire business using the following tenets. Now he has explained the tenets of how to look at a business. Now, business tenets, what are those? Is the business simple and understandable from your perspective through your lens as an investor? Does the business have a consistent operating history? Does it have a long history to carry or track through for you to understand? And third, does the business have a favorable long-term prospects? Does it have a large addressable market? Does it have a long runway ahead? Can it carry its operational history ahead as well into the future, so that the shareholders get the return? So that's the key business tenets one should look for. Now, what are the management tenets? Is the management rational? Second, is the management candid with its shareholders? Are they trustworthy? Are they open enough with the shareholders in whatever actions they do? And are they rational and capable? So that is something which they follow. Third is financial tenets, very important thing. Four things. First one is focus on return on equity. Return on equity is something that most important thing, more than earnings per share, but the whole while the whole market, whole group out there, whole market and whole community out there in the world of investing are day in day out talking about the earnings per share. But what needs to be tracked is a fundamental thesis called return on invested capital or return on equity in Buffett's terms. But I track return on invested capital, which I find it more apt. But pretty much similar lines of thoughts, and that is something we need to track than the EPS. Second, calculate owner's earnings. The book talks about how to calculate owner's earnings, but let me just brief it in a minute. Owner's earnings is different from the actual net profit or net income that you see, the earnings that you see in the P&L, that is profit and loss. Owner's earnings you calculate by, it's almost same as your free cash flow if you look at it. Slightly there are some differences, but it's most of the time almost same as free cash flow. What is it? It's nothing but what is the cash that is generated by the company from its operations. You take the cash generated from its operations and subtract the fixed or the capital allocation or the capital expenditure that is incurred by the company or the capital outlay, and then you arrive at the free cash flow. So you subtract the capex, you get the free cash flow. So cash generated from operations, or you take the net income, using the cash flow, you add back the amortization, depreciation, all of that, and you take the you arrive at the cash from operations, which you can always get it from your cash flow statement, and you subtract the capex, that's free cash flow. And once you get that is your owner's earnings, right? And most often it's your free cash flow. And once you get your owner's earnings, you arrive at the return on equity. Look for companies with high profit margins, because high profit margins are an indication of competitive advantage. When you break down really the return on equity or return on invested capital, you tend to get 2 parts or 3 parts to it. If you do a DuPont, you get the profit margins, you get the asset turnover, you get the leverage ratio, right? And for return on invested capital, you can get into 2 parts, which is basically nothing but the consumption advantage or the consumer advantage or competitive advantage times the production advantage. So the multiple of these 2 factors is what you get in return on invested capital. Now if it is return on equity, I told the 3 factors, right? Equity has 3 factors. When you do the DuPont, it has the profit margin, asset turnover, and the financial leverage, and so, or the leverage, financial leverage. So these 3 multiples can explain what is really underlying causing the high return on equity or high return on invested capital. For me, I like to identify the consumer competitive advantage period, because the return on invested capital really gives you the breakdown of whether the company is achieving high asset turns and high production advantage. It could be low cost, it could be multiple factors, or is it because something durable competitive advantage that the company is carrying. So the high margins translates in both the factors, both the calculations, to great competitive advantage, which Buffett calls it as moat, and that could be due to different reasons, right? How long the competitive advantage can sustain is what drives the runway ahead for the earnings to compound, or for the profits to compound, or for the owner's earnings to compound, right? So that is what we are trying to arrive at. So that is the point he's talking about. 4th point is, for every dollar of retained earnings, has the company created at least $1 extra market value. Now this is an important thesis. Now this is also, if you look at it, it's called the $1 test. It's, if you just Google it, I don't exactly remember, but I've read it somewhere in one of the Buffett's letters. He talks about this dollar test famously, which is nothing but for every dollar that the company puts in, how much for every retained earnings, $1 of retained earnings, how much value does the company create for the invested capital. So it is important, because if the returns on invested capital is high, then, and there is a good growth of the company, that can create a long runway, then you're sure to compound the money for long periods of time. This is called $1 test. You can do more research. I'll probably do a separate video on that. But at this juncture, you need to understand these 4 factors, which are the financial tenets. Owner's earnings is more important than earnings per share. Second is focus on return on equity than the net profit or EPS, which the market is behind. Third is search for companies which has high profit margins, which just indirectly means strong competitive advantage, which can sustain for long periods of time. And fourth is the $1 test, which Buffett calls it. For every dollar of retained earnings, how much value, economic value, will the company create? That is something you need to calculate. And there are ways. There is a good white paper, I think, to calculate economic value. I mean, it's a great paper. I'll probably share that as well. Now, the management tenets we already spoke about, which is what is the value of the business, and can the business currently be purchased at a significant discount to its value. So I think this is a typo. Probably it's called the valuation tenets, right? So what is the value of the business? You have to calculate the intrinsic value. You could use any of the ways to calculate the intrinsic value. And second point, can the business currently be purchased less than the intrinsic value, or do you get a discount, so that there is a margin of safety? That's all it is. So all of these points put together concisely makes the point of how to invest, how to have a long-term investing view based on Buffett's success in the markets. So, and then finally, the fourth point is manage a portfolio of businesses. When you manage a portfolio of 10 to 15 stocks, identified the way that is explained in the top 3 points, the success rate is at least going to be 60 to 70%, and that's pretty much enough. If you compound it 15-18% over long periods of time, the worker's job is done, right? That's what Buffett did. He compounded 20-21%. If you're able to do that for long periods of time, the work is done, job is done. And the important thing is focus. So maybe that's why I brought this in a video. If you could take a printout of this and read this every day, as an activity. For me, as a long-term investor, this is something I have to remind me every day, in order to get carried away with the short-term trades, fads out there, the short-term SPACs out there, and all of that. Cut the noise and focus on what is a fundamental thesis. That will help maintain a good investment track record. Just wanted to bring this up. Thanks for staying with me. Signing off, Sandeep, Anand.